The market is flashing some warning signals right now, and they point to the possibility of a rough period ahead. That means you need to be prepared. You need to have the knowledge. It's not all bad news, and any correction is likely to be followed by serious upside. Remember, you can't have the good times without the bad times, and the bad needn't be a catastrophe anyway, as long as you're positioned for it in advance. Knowledge is key. We are sharing this bearish take. We've seen it shared around the internet, so I thought it's worth addressing. We're sharing the information with you. I don't fully agree with all the takes here. We're going to go through that as we go through. I think there's some key points to remember on this. The key here, anticipation, preparation, knowing what to watch for. Okay, nobody has a crystal ball. We can only trade on likelihoods, not certainties. And likelihood is that the macro setup is too strong in 2026 for all this to play out. Still, though, there is a case for choppy waters ahead, so let's take a look at why the markets may be due for some downside volatility, according to some opinions online. Now, what usually happens after we get through the worst of it, and how you can, of course, turn all this to your advantage. We need to start with a historical red flag. It's a very interesting one. If we look all the way back to 1926, those were the days, man. Those were the days. Anyway, we have 100 years of market data to draw on. We need to check what happened around the 25 midterm elections that took place in that period. The reason we're focused on elections is, of course, because 2026 is a midterm election year, and actually a very consistent pattern shows up in the data. If you're looking, check out this table as posted by the guys over at Bar Chart. You can see very clearly that the 12 months leading up to a midterm are almost always weak. On average, the S&P 500 sees an 18.2% drawdown in that period, and over the last 60 years, the smallest was 7.4%, while the steepest was a huge 41.8% back in 1974. Now, it's a long time ago for sure, but the last midterm year, 2022, saw a drop of 25.4%. Now, things were changing. The Fed was hiking rates. There was a macro backdrop for that. But still, it's relevant to discuss. It's structural in nature, and the market psychology around midterms is the same as it ever was. And by psychology, what I'm talking about is the fact that the markets hate uncertainty. So in the lead up to a major political event, investors shift towards more defensive positioning. That's pretty normal. Plus, this is just my take here, but the markets might be particularly sensitive to elections as long as Trump is the main character. Since Trump is so focused on the markets, what's he want? He wants to run the economy hot. He wants to invest in AI. He wants to invest in robotics. He wants to make shit tons of jobs. He wants to lower interest rates. I mean, all good things, but still, that's his agenda. And if he doesn't get the midterm win, his agenda might be on the rocks. He wants to pump stocks. He wants to pump crypto. And so the markets are perhaps more reactive to what goes on in DC and what gets tweeted out of DC than ever before. However, the flip side to this pattern, defensiveness amid uncertainty in the midterm run-up, is that when the results are in, the markets can switch very quickly and will be primed to the upside. And in fact, you can see this pattern right there in the historical charts. It's red before the midterms, green after the midterms. That's happened almost every single time, giving an average gain of over 12 months after the midterms around 14.8%, also aligning with the general patterns of around a midterm year. But there are some other bearish propaganda we need to discuss. But before we break down that, look, bear, bull, up, down, good time to sell, bad time to sell, whatever, none of it really matters, because guess what? You can trade no matter what the market's doing. You can bet on it going long, you can bet on it going short. And if you're serious about trading crypto, then you need to be over on Femex, the platform built for global traders. It's fast, it's secure, it has all the coins you actually want to trade with the liquidity to trade them. I've personally been using Femex for years because it just works, okay? No nonsense, and yes, it's available to everyone, everywhere. You might need a VPN in some cases. And listen to this, because right now they're giving away up to $1,600 in cash back bonuses. You put in your deposit, they're putting cash back in your pocket. It's insane. Plus, the more you trade, you can actually get up to $20,000 in trading bonuses as well. Absolutely mental deals here, guys. This deal will not last forever, so hit the link down below. Grab it before it's gone. So, the bearish points. Look, first off, we have CDS spreads on some big AI infrastructure players. They have risen, while investors perhaps are more worried than before about the sustainability of aggressive debt-financed expansion. This kind of credit market anxiety doesn't happen in isolation, as it can affect stock prices, and this can then bleed into risk assets more broadly, particularly when so much is riding on the AI trade right now, which is basically holding up the entire US economy, as Main Street tends to be in a position where they're suffering a lot right now. So if AI makes a broader correction, it's more likely for economic conditions to then wobble. And as it happens, economic conditions, of course, are not super stable already. Inflation is proving, unfortunately, sticky, with some recent forecasts, including from the Bank of America, expecting U.S. inflation to remain at around its current rate in 2026. While at the same time, there are some concerns about the job market, about unemployment. Those are very well founded. Unemployment is going in the wrong direction, up. Job markets have been seriously suffering the last few months, and the ISM manufacturing PMI is below 50 for the 9th month running, meaning we are still within the period of the longest contraction of the business cycle in U.S. history. That all creates a tricky situation. On the one hand, rate cuts could spur further inflation. On the other, a lack of cuts chokes off growth and freezes the housing market. It can make unemployment worse, which is why the Fed's cutting, because they're now more worried about unemployment than inflation. And that may be why we have another problem. Internal conflict at the Federal Reserve. A divided Fed makes policy decisions unpredictable. And as mentioned, the markets hate uncertainty, man, which is why we see markets rally as it's become more certain that the next Fed meeting will have a rate cut. But whether it's the Fed, whether it's elections or anything else, markets do not like when they don't know what's going to go happen. We get the kind of combined pressure that leads to market drawdowns. So yeah, we get a cut in December, but what about until Jerome Powell leaves in May? It's a long time, a lot of Fed meetings between now and then. That all being said, though, there may be a silver lining. Most importantly, drawdowns can be launch pads for major rallies to follow. So if a correction does come, maybe we get like a bullish Q1, for example, followed by a big summer lull in the run up to the midterm. Okay, none of this is happening overnight. I'm not calling for a bear market overnight or anything like that. But if that happens, great buying opportunities. But you need to reduce exposure to risk before that happens. Make sure you have cash at the ready to allocate at the lows, because it'll probably be a great buying opportunity. This kind of drawdown in a midterm year is a buy the dip territory in anticipation of a post-election rally. And by the way, to keep up with what you should be considering to be buying, make sure you sign up for my free newsletter. It's awesome. Crypto, stocks, macro, we got it all covered. Link down below. Also take a look at this chart posted by Ryan Dietrich. It shows how the NASDAQ performed after the 1995 Netscape IPO, seen as the internet's big bang era as compared to after the launch of ChatGPT 3 years ago. There are similarities. And if the parallels continue, then there could be a dip next year, but followed up by an insane upside rip into the last 2 years of the Trump presidency, which ties in cleanly with what we've already outlined. Red into the midterms, green after. Doesn't mean red starts today. Red might start in April, for example. Also, this potentially syncs up with what's kind of been happening in crypto. If the cycle did actually peak in October, I still have my doubts. In fact, I got a lot of doubts for a variety of reasons. Anyway, then a typical bearish trend should bottom out around next October. I'm not sure about this 4-year cycle thing, but we'll throw that on some confluence here for you. Plus, it looks almost certain that an extremely dovish new Fed chair takes over in May of next year. Trump has talked about scrapping income tax, about stimulus checks. Scott Bessent's promising tax refunds in 2026. The China deal's going ahead. There's so many good things coming. Massive economic boom due to all the AI data centers being built, the nuclear power plants, and all that kind of stuff. And keep in mind, there are huge catalysts for a post-correction, post-midterm rally with AI, robotics, energy, quantum computing, space travel, all accelerating from here. Or in other words, if this does play out again, okay, and we're in unprecedented times, longest business cycle contraction in history, for example, a yield curve inversion that did not lead to a recession, all this kind of stuff. We're in weird times right now, okay? If it does play out, and let's say mid-year or next year we get a big dip before the midterms, it's probably a dip buying opportunity. I want you to remember that for when it comes. I'm not saying this starts tomorrow. Q1, Q2 could still be really good. Again, maybe like a top in April or something like that, followed by down only for a while as markets start getting antsy about what could happen in the midterms. Okay, but that will not be the end of all things. It'll be an opportunity for the prepared. Thanks for watching.